Okay, so hello everyone. Welcome to this kind of macro overview. Just for the record, I'm recording this on Sunday, May the 5th, about 5:30 p.m. in the afternoon, so towards the end of the weekend. I thought what we'd do, guys, we had quite a lot of data this week, well, actually last week. So it's maybe a good moment just to review the overall situation. So let's just first of all look at the data, because what the market is trying to understand is, is the economy weakening? Is the labor market weakening? And what's happening with kind of prices paid or inflation? And then we'll get on to the FOMC and Powell's reaction. So what we had last week, we had in general, a situation which seemed to be showing that the US economy is still relatively robust, but maybe showing a few signs of some weakness, just a few signs of some weakness. And we saw that in the survey data, so not the hard data. And keep in mind that the survey data has been not super correlated with the hard data, but we saw in the ISM manufacturing and the ISM services a small amount of sort of weakening. We saw that the JOLTS labor market was down just a little bit. And we saw, of course, that the non-farm payrolls, although the number was reasonable, seemed to indicate a slight slowing down. So overall, it seems to be that the labor market is still pretty robust because, for example, we saw in the initial jobless claims that was still, a very, very good level. But overall, it seems to be that prices paid is still pretty high. So we saw that the economic cost index, the cost of labor, the employment cost index, which is the total cost of labor on, I think it was Monday, was much higher than expected. And we saw that here, this big spike in sort of yields. And then we also saw that the prices paid elements in the ISM services and the ISM manufacturing was also higher than expected. On the other hand, that was contradicted a little bit by the average hourly earnings on Friday's non-farm payroll number. So one thing also to mention, and just to be absolutely honest, is that we are getting data which is quite contradictory. And this is also a bit of an issue. And we can see here what we're seeing here on this sort of chart in front of us. This is a 3-minute chart, more or less the last 5 or 6 trading days. The number on the right represents the amount of basis points priced in by the market for by December 2024. So cuts by the end of this year. And what you guys can notice is that on any particular given day, any particular data point, it's going, it's pricing out cuts. So we're at here, about 42, and then going up to 30, and then kind of stabilizing. Then, as it goes up here is much more sort of hawkish, then coming down, a bit more dovish, and then boom on non-farm payrolls. So this is making it a very challenging environment to put on sort of medium or longer term trades because everything's going up and down. Literally 3 or 4 times a week. So the best thing we can try and do is maybe try and do a few little tactical trades. But then, of course, at that point, you have, algos moving very fast. So it's a challenging environment at the moment. Probably the best thing to be doing, or what I'm trying to do, is trying to fade moves. I think that's the idea here, is to fade extremes. And the week coming up, which is this week beginning Monday, May the 6th, there's not particularly any data. There's not particularly many earnings. The next major earnings we will have, the final one is going to be NVIDIA, I think on the 20th, perhaps, or is it the 22nd, I think. So this is maybe a week just to be fading extreme moves to the top side or the downside. Could be a range trading kind of week, because as you're saying, and just in terms of the volatility, I found something over the weekend kind of interesting. And this is just looking at the realized volatility versus implied volatility. And as you guys know, this is a spread analysis of the VIX, which of course is implied versus realized volatility or historical realized volatility. And you can look at some of the numbers here. And basically what you can see is that the number in the dark gray here is the implied volatility. And the one below is the realized volatility. But and normally, of course, that the implied volatility is higher than the realized volatility. You can see back in November 23 when we had quite a lot of movements that did cross over. But essentially, normally that's higher. But what we can see here was actually starting to cross over. And that means now that the realized volatility, so what's actually happening in the market, is in fact higher than the implied vol. And essentially what that sort of normally means is that the fact that the implied volatility, which is not huge. I mean, if we just look at the VIX here, we can see this. Let me just throw up a quick daily chart of the VIX here. You can see that the VIX has actually been going down for the last, what's that, 8, 9, 10 trading days. This is a daily. So, as we speak, it's about 13.5 or so. So the implied volatility is going down, which means the market doesn't particularly think that the stocks or the bonds are going to collapse in any shape or form. But as I said, if you're going back to that graphic there, you can see that the realized volatility is implied in that. So what that seems to be saying is that we're going to get quite large moves, quite a lot of volatility. But in general, they will mean revert, or they will revert back to the kind of equilibrium point. And so what that means, I would say, is that we're in a market which is confused by the data, because the data is contradictory and is literally contradicting itself. It's not exactly sure what the Fed is going to be doing. It doesn't really want to go down, but doesn't have enough energy to go up. And so, as I say, as a trading strategy, I think it makes sense to be looking at different instruments and saying, well, okay, that's kind of like the top of a range or an extreme. That's the bottom of the range or an extreme on the downside, and trying to fade those moves. That's what I'm trying to do this week, if it's going to be possible. And so one of the reasons for that is, as I said, we got a little bit of contradictory data last week, and I think overall what we're trying to get here is that we kind of had this idea that maybe the economy is slowing down, but we don't necessarily have a Fed which is cutting. And if we actually go, again, I'm just going to go back to what's priced in by the market for by December of 2024. You can see it's going up and down, but essentially we sort of started the week pricing in about 1.5 cuts, so about 42 basis points. And then, after the initial sort of dovish move downwards on a Friday morning, it came back to about 45 basis points. So by the end of the week, essentially would only move 3 or 4 basis points in terms of the pricing. In this case, a little bit to the dovish side. And I think that's just because if we go back then to the FOMC, which of course we had during the week, I mean, what did Powell tell us? He reminded us that there are 2 mandates. You have the mandate for employment, full employment, and price stability. And what he basically was saying, the market was a bit fearful that there could be the possibility of a hike. And the market had actually moved a little bit of the probability distribution to the right, and to say, well, hey, maybe there's the possibility of a hike. But Powell essentially took that off the table, or at least gave us the understanding that it would be a very, very high bar for the Fed to hike. And the market quite liked that. We see that here, in the afternoon here, we saw that the market had been pricing in only about just over one cut. And by the end of that, had got down to about 1.5 cuts or so, and has kind of been sliding ever since. But all it takes is 1 or 2 hot data points, and this, of course, could go up and price out the extra half cut. And keep in mind that we don't have CPI this week. We have CPI the following week. I think it's the 15th. I think it's a Wednesday morning on the 15th, and that's going to be the next strong data point. So Powell basically seems to be saying that of the 2 mandates of the Fed, full employment and price stability, he was saying that they've done a lot of the heavy lifting on the price stability. It's not perfect yet, but he was essentially saying that his eye is now also looking at the other mandate, more in balance, which is employment. And what that seems to be saying, it seems to be a little bit asymmetrical. He reiterated the fact that he believes that over time, maybe not quickly, but over time, he did believe that the Fed would bring inflation down to about 2%. But he was also wary about unemployment, the unemployment situation sort of rising or getting worse, or the employment market sort of weakening, and that he essentially was saying to the market that if he were to see evidence of an economic slowdown, specifically in the employment market, he gave the market to believe that they potentially could cut. On the other hand, they probably wouldn't hike if inflation took a little bit longer to come down to target. So you see, it's a little bit asymmetric, and that's why I think the market has taken that as a slightly dovish kind of sort of interpretation of that. The idea that it's almost like a Fed put, sort of saying, well, we're probably just going to wait if inflation's sticky. We're not going to hike anymore. But on the other hand, if the employment situation deteriorates or the real economy shows signs of deterioration, we would support it. So I think at this point, it's becoming a little bit asymmetric. Having said that, he did reiterate many, many times that they were still data dependent, and they still needed a lot more confidence. And so the issue here is, in order for them to actually start cutting, not just to intimate that they're being patient, but to actually indicate the beginning of a cutting cycle of 3, 4, 5, 6 cuts, they would need a lot more confidence. Now, what does that mean? We could assume that probably means, you know, a consecutive 2, 3, or 4 data points of CPI and PCE coming down more to target. And also we would probably need to see, on the other hand of the equation, for the other mandate, we would probably need to see evidence that the employment market or the labor market was weakening and maybe the real economy was weakening, which we haven't really seen yet. So I think the takeaway for me, just trying to think about it a little bit this weekend, is that maybe we've seen the high in terms of the front of the curve in terms of yields, but we're not yet at the point where the Fed has given the signal to cut. So I think at this point, it's going to remain in a chop. We're going to remain in sort of a range. And let's look at a few markets for that. So it seems to me that if we just start looking at the front end of the curve, it's probably a pretty important one here. Let's look at, let's say, for example, the 2-year yield. I'll just bring that up on the daily chart. Which is this one here. Okay, so as you can see, we didn't quite get the Fed funds rate at this point is about 5.33%, so 533 basis points up around here or so. And what I had this marked here that, you know, were that yield to get higher, that would be an interesting point to actually sort of be buying the 2-year. It didn't actually quite make that. And just for the reasons we saw with the slightly dovish, in theory, non-farm payrolls and with Powell's comments we just discussed, we see here that the yield on the 2-year has come down. Now, why is that? That's because the market is essentially saying that, you know, if the Fed's not really going to hike anymore, you know, we're getting into a zone here which is relatively close to the current effective Fed funds rate. And so it's going to be hard for the 2-year yield. And again, that's not today, that's going out for 2 years to get anywhere, you know, too close to the effective funds rate. Now, if we do get hawkish CPI and hawkish economic data, can this 2-year yield go up to test here? Absolutely. And that's probably, you know, another 25, but yeah, there's 25 basis points there. So that's possible. But again, I think if we were to get up towards these levels and retest up that would probably be a pretty good area to be buying, let's say the 2-year bonds, or on the futures, the ZT, or maybe that ETF, the TUA, for example. That would be a great entry point. At this point, it's just sort of bouncing up. So that's something I'll be looking for, definitely, is to maybe add to a position there or to buy there. Now, in terms of the long end of the, so we're going to have to wait, though, until the signal, because if for example, the Fed wants to cut, they will need, as I said, probably 2 or 3 or 4 months of consecutive positive data and in that case, we'll probably get this yield going down, you know, maybe, I don't know, 75 or 100 basis points down to around here somewhere. And of course, that'll be a great moment to be owning the 2-year or the front of the curve, maybe SOFR Z5 or something like that, 25, something like that. But we're not there yet. And that's why the next 2 or 3, 4 months, probably over the summer, is going to be a little bit frustrating. It's going to go up, it's going to go down. And we just have to, as I say, probably the best way to look at that is just to look at extreme levels and try and fade those, because I don't think it's going to go too much up, but there's also no reason for it to completely collapse at this point, talking about the 2-year. Now, if we look at the long end, that's kind of interesting. I just want to bring up the term premium here, which I think I've got here somewhere. Yeah, so this is the term premium. Now, what is interesting is that we had the QRA this week as well. And we had, it seems, a little bit less, the quantitative tightening is going to be reduced a little bit, but that's not really going to affect the long end. That's really going to just be more issuance for bills. So at this point, what we do have, though, is continuing heavy issuance. Both the Biden administration and who knows if Trump comes in, the political landscape, in my view, is such that the US will continue to have very large deficits for the foreseeable future. We're now in a situation in the US where the deficits are equivalent to what we saw in COVID, or what we see in a deep kind of recession, or even what you might even see in a war kind of situation. So we have extremely high levels of deficit spending, which means that the Treasury, even though they might change it from month to month, at the end of the day, what we're seeing is a huge amount of issuance, which is going to put, you know, structural pressure on the long end of the curve. And what we could see is that the term premium, especially if we continue to see inflation remaining sticky, if we see economic growth remaining relatively robust, that provides uncertainty for the long end of the curve and with the heavy issuance. And so therefore, the extra yield which investors demand to buy long-term bonds rather than just rolling over short-term bonds, which is the term premium, which is this graph here, we could expect that it's been rising. You see here it was at about 0. It's now up to about 23 basis points, and there's no reason why that can't go up another, I don't know, 10 or 20 basis points up to positive 40 and retest those levels which we last saw in sort of autumn of 2023. So all that to say is that if our thesis is that the front end of the curve is relatively stable, relatively anchored, maybe the yields will go up a little bit, maybe the yields will go down a little bit, but we're really waiting for more confirmation one way or another from the real economy, from employment, and of course from the CPI and from the Fed. Probably where we're going to have the most volatility is going to be at the long end of the curve. And to be honest, I can't really see too many reasons for the long end of the curve to outperform the front end of the curve, just because we still have sticky inflation, we still have a relatively robust real economy, and we have heavy issuance because of the very large fiscal deficits being run by the US government. So in that case, I guess what I'm trying to say here is that if the term premium does go up, that's going to hit the long end, like the 10s and the 30s more than the front end. And that's just going to cause, I think, a steepener. So let's look at some of the yield curves here. We'll just bring on to that. And my point here is that let's say we look at something like the 2s 30s, which is kind of the most extreme one. We have seen a little bit of steepening because if the Fed does start to cut, and again, I emphasize, I do not think that's going to be happening for another few months at least. There's definitely has to be more confidence, as the Fed says. So another 3 or 4, 5, 6 months. Let's not get too excited, but that would cause a front-end led bull steepener. And if, on the other hand, we see that the real economy continues to be robust, that inflation, there's not much progress, the US Treasury continues just to keep on issuing bonds. And by the way, next week or this week, we have, I think, the 10s and 30-year auction. So that should put some downward pressure on the price for the long end, which causing upward pressure on the yields. So I think we'll get a bear steepener in that case. So what I'm trying to say is that probabilistically, at least in my humble opinion, the possibilities of having a bull steepener at a later date and in the shorter term, a bear steepener are higher than having a flattener. Having said that, it has come a little bit of a way, and I want to be very careful about entering. So personally, a trade I'm looking at would be if we get some kind of nice discount, maybe down, 10 basis points, around about this minus 25 basis points. I think that could be interesting for a tactical steepener. Again, I want to emphasize the cost of carry. You don't necessarily want to be trying to hold these things for 3 or 6 months. I've tried to do that, was a little bit burned. It's difficult to hold these things for many, many months. But certainly if the curve on the 2s, 30s gets down to about minus 25 basis points, I think that's a pretty attractive entry point. Similar kind of thing if we can find the 2s, 10s here. Again, you guys can see that it's kind of steepened a little bit, just being rejected. Again, I think something like about minus 36 basis points on the 2s, 10s could be interesting for a tactical steepener. So that's a couple of things I'm looking out for. The other thing as well is that you see on the 2s, 5s, that's a bit of at the front end of the curve here. Do I have that? I think I've got that one here. That's something just to keep an eye up to. But, again, I think the 2s, 5s, if that comes down just a little bit here, I anticipate that could get up to, maybe up to these levels here, sort of, 22, 23, 24, minus 22, 23, 24 kind of basis points could steepen up there. The idea being, again, that the 2-year will be relatively anchored and relatively stable, and that the further out the curve on the 5s could also go up there. So that's something to be looking out for. But again, we have to wait for more confidence. The Fed wants more confidence. They need another 2, 3, 4 months. So I think that's going to be a story grinding through the summer, and then we'll see what happens. Now, of course, what does that mean for bonds and stocks? I think that means a bit more chop, a little bit more indecision. And we'll get onto the stocks in a little bit. But just quickly looking over to the European space, which I want to do, I think it's a relatively similar kind of situation. If we look at something like the Schatz, which is the front end of which is the 2-year over in Germany, again, that shouldn't go too much lower in prices, because the ECB, let's be honest, if the Fed said they're probably not going to be hiking, what chances that the ECB is going to be hiking? And remember that the ECB more or less told us that June was more or less a go for at least one cut. So I do expect that the 2-year, the yield is going to be pretty doubtful that it goes up too much. And again, that also should sort of be steepening a little bit. But what is kind of interesting here, again, so the similar kind of situation in Germany, that if you see, let's say, for example, on the 2-year, for whatever reason, the Schatz, the yield on the Schatz going up, testing up at, 3, well, maybe not 3%, but let's say something like about 305, 308, something like that. That would be a fantastic buy level. Similar kind of situation on the fives on the bubble up to about 2.6 here. That'd be a fantastic entry level to be buying. This is the yield chart there. What is kind of interesting is just looking at the yield curve as well. That should steepen a little bit. But the other thing which is I'm going to look at here is the let's say something like the German. What have we got here? Let's say something like the US 10-year and the German 2-year. Again, that possibly could go out in favor of the US, because at the end of the day, it seems as though the US economy, it seems, is outperforming the European economy, although we had some signs of stabilization. But just in terms of the future path of the respective central banks, I think over the next 3 to 6 months, in theory, the Fed ultimately will probably be a bit later to get into the cutting cycle than the ECB. And we have to assume that the ECB might cut maybe sooner and perhaps more deeply than the Fed. And so therefore, something like the German 2-year and the US 10-year could be an interesting one to play. The idea being that the yield on the US 10-year would go up more than its cousin, the front end of the curve in Germany, sort of maybe up to here or so. That could be an interesting play to be looking at. The other interesting one could be, if I could find the German, this is the US 10-year versus the German 10-year this time. That could also maybe be going up to, 2.1%, something like that. And that could be an interesting one to play this week, just because, as I say, in the US, we have the extra issuance. We have the auctions coming up over the next few days. So that could be an interesting one just to drift up there. I mean, how many basis points is that? That's about 8 or 9 basis points just up to there. So that would be selling the US 10-year, buying the German 10-year. That's an interesting one. Okay, so let's now, guys, look at over the FX space here. Again, I think we're going to have a little bit of chop. There's no particular reason for the dollar, the Dixie, to sell off. What you guys saw is that, I mean, it's kind of interesting to look at the reaction here. We saw that there was like some kind of bull flag. I mean, this was the end of a measured move here. We can just look at this here, just from a technical perspective on the dollar index. And so it's no surprise that it kind of, came down a little bit. You see here this measured move sort of finished. It was sort of bull flagging, but then with that sort of, so-called dovish sort of FOMC meeting on Wednesday, and then the, slightly less hot than expected non-farm payroll numbers, we saw the US dollar or the dollar index just sort of come off. But it's interesting, you see it, the sort of the technical support here immediately bounced. And that's reflected a little bit in all the other sort of cross currencies, that there's no real reason at this point to be selling actively the US dollar. I mean, it could go up and down a few days here and there, but at the end of the day, you've got to say, any other central bank's got to be sort of more hawkish than the Fed at this point? Probably not. Are any other global sort of geographic jurisdictions got to be more sort of outperforming economies than the US? Probably not really at this sort of point of view. So I think again, it's a question of fading extremes. So maybe I don't know, could this go up to, like, over the next week, 105.60, something, around about here could be interesting, kind of just sort of range at the top there, maybe down to 104, sort of 80-ish. So I think basically the dollar, anything up around here could be sort of interesting to kind of sell potentially. Although I don't love that level, I prefer a level up here, but that's probably a bit optimistic. But certainly if the dollar does get down, as I say, to this level again, I think it'd have to be a buy, at least this week in the short term. Similar kind of thing if we look over at the euro here. We see here that the euro did attempt to bounce, but again, sort of gave that back on sort of Friday afternoon. And maybe up at something like 106.90. Could be sort of something on the down range here, just sort of ranging in this zone here. But again, what would be a fantastic price to be selling the euro be much more up here. I don't know that we're going to get that. So let's keep on looking there. In terms of the other issues, we have the Bank of England this week. Let's see what happens if they're at all dovish. This could turn into a nice sort of retracement here, and the pound could have some downside. As you see, the pound again, like the other currencies, tried to rally against the dollar on Friday, but sort of gave it back. We do have the Bank of England on Thursday. I'll talk a bit more about that later in the week, but if that turns out to be a bit more dovish than expected, for sure, the pound could be a test down here. We also have the Australian, the RBA, again, rejected at this sort of key level here. And this is what I mean about trying to find levels if you're able to, and happen to be in front of the computer when it's going on, which is not always easy. But this was, in retrospect, a pretty good level here to be shorting the Aussie dollar against the US dollar, maybe not against other cross currencies. Having said that, Australia's economy is still doing quite well. China seems to be grinding out of its sort of slowdown a little bit. And employment situation seems quite strong in Australia. And also the last CPI print in Australia was relatively strong. So let's see what the RBA has to say, because if they actually hold it in a hawkish way, maybe you want to be buying the AUD versus some cross pairs. That's something I'll be looking at in the next couple of days, just trying to better understand that. Because again, against the US dollar, no one says you have to buy and sell against the US dollar. Could be some interesting possibilities with the cross pairs. Now we know that there was potentially intervention by the Bank of Japan last week. That makes it difficult to trade the yen, just because at any given moment it could be moving 3%, 3, 4, 5, 600 ticks, blast through stop loss. Not easy to be trading that. But what's got my attention though is there's quite an interesting level here, USD JPY on the spot. I mean, if this gets down to this 151.9 area, let's say in the next 24 hours or so, that could be quite an interesting one, because I think the immediate chance of an intervention by the BOJ is limited, because let's just have a look at it from where we were. That's come down almost 5%, which is a big chunk. And so if it does get down there, I think that's something definitely worth maybe a shot. You have a pretty good risk reward here. You could sort of get in this kind of level here, stop loss down here, and potentially, aim to get 1% or 2% on the upside. Because again, there's no particular reason to think that the Japanese economy or the interest rate differentials should be favoring the yen. So that's definitely an interesting one to be looking at. I want to keep an eye on that. In terms of gold, just want to have a look at gold here. Gold is interesting. I was reading a lot of stuff over the weekend. A lot of talk about the People's Bank of China buying a lot of gold, and it's true, they have been buying a lot of gold, retail demand. And I spoke, I think, a few days ago in a video about the fact that if you look at gold priced in renminbi or Japanese yen, it's actually outperforming even gold priced in the dollar. So it does seem to be some price insensitivity there. But what's interesting is that gold in this last week, for the first time, is acting in a slightly more classical way, by which I mean that with hawkish data, gold actually came off a little bit. With the real yields going up, gold actually came off a little bit. With the strongish US dollar during the week, it sort of came off a little bit. So I just wonder if gold is reverting to its more classical correlations with things like real yields and strength or weakness in the US dollar. Having said that, on the other side, it's always difficult to know. There does seem to be a lot of buying by the People's Bank of China. Other central banks, we know that the Reserve Bank of India is buying a lot of gold, plus retail demand. So I'm personally quite interested just to see with these longer term fibs and the shorter term fibs. As I say, in this blue box here, I've had this marked for a little bit. If it comes down to that kind of level, I think that could be interesting sort of as a buy. Down to 22. I mean, it could even do an ABC down here, 22, could break down here, 22.50 or something like that, 22.40. But I think certainly around about this level here, 22.60 would be worth a shot. Maybe with some call spreads, maybe long call spreads, because I think that's quite a good risk reward there. Certainly, if you got stopped out and it came down to this level, I think that would be a tremendous buying point, entry point. But again, that's quite a long way away, and possibly that's not going to be happening. On the other hand, if it rallies up to, maybe up here, would be a good level. I mean, I had this level up here from last week. Maybe again, that's overly optimistic. So I think gold, again, maybe you could have a short selling here, certainly selling up there, maybe buying here and certainly buying down there. Again, I think just for this week with a lack of data, lack of central bank action or large central bank action, that's the way to be looking at gold. But just probably what I'm going to be doing is tomorrow, Monday, looking just at the relationship of gold with the US dollar and real yields, and just seeing if it's acting in a sort of more a sort of a classic way. Silver, kind of interesting again. Silver's a tricky one. I mean, this is an interesting zone here. As you can see, a bit of support here. It's also a congruence of two fib levels. If gold is falling, hard to see silver sort of rising. But again, and it has less of a sort of a safe haven kind of appeal. So I might leave it alone, but it is possibly interesting. SLV, again, maybe call spreads. You have a pretty good, you can control your risk quite well there. And you essentially, if it goes down here below the fib levels, you're kind of wrong. So that's interesting one. But what I have been looking at as well quite a lot last week is copper. As you guys can see, copper had a very, very big breakout. I'm not going to call it parabolic, but very, very strong. Just been bouncing between these levels for a few days. What is interesting, this is the VWAP where a lot of the big funds, bought over the. If you look at basically what I'm trying to say, if you look back at the volumes over the last 4 to 6 weeks where the heavy buying came in, that is sort of the volume weighted average price level. So the point is that if the price were to go below this VWAP level here at about 4.38, we can assume that those buyers would be underwater and there could be some downside pressure. We're not there yet, but that would be an interesting level. But in the meantime, you've got some quite interesting fib retracement levels here, down here, and I've got it marked here and down here. I think all of these levels here would be quite interesting to possibly be looking at long copper, because I think structurally, we all know for the electricity grid, EVs, all that kind of stuff, there's good reasons to buy copper. There's also sort of a lack of copper production, medium and long term. But again, it's just a question of just want to see. Oh, is it just opened Monday? Yeah. Okay. So as I talk here, it's 6 a.m. So it seems to have gapped up a little bit. Okay, maybe too late, but we'll see how it goes. So that's something interesting to be looking at. So just the other thing you just want to be looking at here is oil. And this is a very interesting one. Oil. We have an OPEC meeting coming up. Now, oil, okay, there was sort of a head and shoulders here. Oil broke that on the builds. We had pretty heavy builds with the API and the DOE. That was also the Wednesday with low liquidity. May Day, there was a lot of markets globally were closed. Oil broke down below that sort of head and shoulders formation here. You can see that's kind of the shoulder, and it broke down. These purple lines here kind of represent moving averages. So if we just throw on a couple of this is a simple moving average here, the 200 and the 100. You can see we're at pretty critical levels here down there. Now what's kind of interesting at this point, I'll just get those off. Sorry, guys, we'll get those off. Is that also if we throw on a couple of fibs, we can see that we're at the 50% fib level there. So this is starting to get into quite a key level. Now, if it were to break this uptrend, of course, this would be a beautiful buy level here at about 75.20-ish, something like that. And that's possible. Having said that, I just want to look at the time spreads, which I think I've got one here. Sorry, let me have a look. Okay, yeah. Well, not so much the time spread, but just the curve. And what you can see is this is the curve as we speak. It's in a pretty aggressive contango. Now, I know the price has come down a lot over the last week, but if we actually just put it on from a week ago and just see what's happening here, just let it sort of zoom in. So I'm going to just zoom in a little bit, guys. So where we are now is the orange line. Now, of course, the price has come down. We were in a pretty aggressive contango. Now, yes, it's starting to flatten out a little bit, but still in a relatively healthy contango. So I would say at the moment that's not necessarily super bearish. Definitely that curve is flattening a little bit and the price has come down. So not super supportive, but I just want to put your attention to the fact that oil is at an interesting level technically. And we're seeing a tiny bit of green. It's opening. Again, it's just a few minutes after 6 p.m., so I wouldn't read too much into that. But if it can hold this uptrend and this 50% retracement level here, which is also one of the major moving averages, it could be that maybe that's enough for oil, and it could be interesting to do some call spreads. Unfortunately, unless you have options on the future, you're going to have to wait until 9:30 tomorrow morning for, let's say, something like USO. But I think that could be interesting. And let's say the call spreads to oil, maybe at least to test the neckline up here, or perhaps a bit further up over the next couple of weeks. It's interesting as well, that was the CL1 contract. If you look at the front contract, June, you can see it's a pretty interesting horizontal level here. Again, if you're looking at some technicals, if you want to put in, let's say a fib level there, that's almost like the 68 there. If we come back, I don't know, there, it's the 50%. So as you can see here, a reasonable level to have a shot. Now, of course, that could just go, I wonder if there's a bit of an uptrend up there. You see there's the uptrend there. Of course, it could collapse through there. We also have to throw on, as I said, the some simple moving averages there. You see there's the congruence of the 100 and the 200 for the June contract, the front contract. So all that to say, a pretty key level there, quite a lot of support. Would not surprise me if oil bounces from this level. And one way to have a look at that, I'm just actually curious here, look on the 1 minute chart. Oh my God, there you go, as I speak. Okay, so that's opened up. Wow, that's opened up 40 or 50 ticks up. Yeah, the other issue there as well is that OPEC Plus is the next meeting. There's some sort of talk of them rolling forward their cuts, keeping the cuts going into the second half of this year, which at the actual margin, should gradually tighten the supplies. And also we have driving season starting to come up in Europe and North America in the summer, which historically draws down a little bit. Okay, just finally, guys, just want to have a look at equities markets, of course. As we discussed earlier, we see that the VIX is down. We see that oil, has come off quite a lot. So that should be putting, all things considered, a bit of a cap on the yields, because you know that the yields often go up as oil price going up. So oil has come off, so that should put a cap on the yields. Low volatility. Just look at the SPX. I like to look at the cash market here. Well, there's some moving averages there. That's just like the 50-day moving average here. So you see gapping up 50-day moving average here. Personally, I think that what's going to be interesting, it could just trade in a range. We don't have NVIDIA earnings for another couple of weeks. We've had all the other, relatively positive. I think what we could get is an SPX maybe up to 5180, 5190 level, something like up to about here. Basically, this sort of orange mark I've got up here, which is there. I think personally, we'll have some long call spreads on this one. So I'm hoping this kind of grinds up this week. Again, I don't expect this to have enough energy and power to break to new highs. But on the other hand, you have to say to yourself, why would this come down? Now, I know a lot of people on Twitter are saying that, with perhaps extra term premium, that an extra issuance, eventually the long-term yields will go up. That means that the R-star, the neutral rate will go up, the discount rate will go up, which should weigh on the multiples for equities. Now, that's a very good technical argument, and absolutely that could be the case. But I think that's really a case for maybe over, a multi-month time frame, just in terms of what we heard from Powell, non-farm payrolls. Quite a supportive scenario last Friday for equities, in my humble opinion. You have average hourly earnings not accelerating. You have, a relatively robust job market. What's not to like? I mean, things are going, relatively well. So that to me seems to be in the short term, by which I mean up until CPI at least, which is in 10 days, a relatively supportive market for equities. So we're long call spreads. Again, I think by the time it gets up here, or even to test these highs, it could be into CPI. And at that point, it's a crapshoot. If we have a lower than expected CPI, that could be the cause for a boost up, or it could be indeed a moment to be, selling some calls, or maybe long some put spreads. And of course, could it come down all the way back down here, 49.50? Yes, absolutely. But I don't think that's going to happen anytime soon. I think that would be a case of maybe NVIDIA disappointing, maybe in conjunction with a higher than expected CPI that could come down. Similar kind of situation with the NASDAQ. So as I say, I expect this week that to sort of maybe grind up. Could it drift lower? Yes, it could. So I think my main point of this week is maybe not to be, to be selling up here, or actually more like up here, and maybe to be buying down here if we do get that. Probably we're not going to get those kind of moves. I think I'm hoping it's going to just retest up to that level here. That's really what I'm thinking about for the equities in the absence of any other news. Okay, guys, I'm going to leave it there. That's sort of my thoughts for the week about what's coming up. Hope that was useful. And as I say, keeping an eye on oil, which I have a feeling is going to push up and out probably overnight. Who knows, maybe by tomorrow morning it might be too late. We shall see. Okay, take care, and we'll keep on talking. Thank you.